Hello and welcome to Outlook Money's Investment BTC podcast series. This episode is led by ICICI Prudential Asset Management Company Limited under the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I am Versha Jain from Outlook Money, your host for today's session. Welcome to another episode in our series where we simplify the complexities of finance to help you enhance your understanding and work towards greater financial well-being. Brought to you in association with ICICI Prudential Asset Management Company Limited. In today's episode, we will discuss ICICI Alpha Low Volatility ETF, the factors it is based on, and explore its potential and relevance in today's market. This ETF has constituents selected based on alpha and low volatility factor. Factor funds are also known as smart beta funds, aim to invest in stocks filtered through specific factors rule. Among the hundreds of such factors, some of the most popular include alpha, momentum, value, quality, and low volatility. And investors have the choice uh, from a range of ETFs from single factor to multiple factor ones. In the current volatile market, the question arises, what factors should investors focus on? Could low volatility combined with growth potential be the right choice? Today, we will explore these factors in detail through the Nifty Alpha Low Volatility 30 ETF for ICICI Prudential. To guide us on this journey, we are joined by Mr. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC. Let's get insight into this exciting realm of factor investing. Welcome, Mr. Haria, to this episode.
Hey, Versha, and a big hello to every listener of Outlook. Thank you.
All right, let's start with the basics. ICICI Prudential Nifty Alpha Low Volatility 30 ETF combines two factors, alpha and low volatility. So, could you explain these factor concepts and their significance for our listeners?
Sure. So, we have done a few podcasts on Smart Beta, and as you mentioned,
Hmm.
Smart Beta is essentially selection of the securities based on certain factors. It could be price factors, technical factors, or quantitative fundamental factors. Now, in India, generally the popular ones were are rather volatility. Low vol is the one which is for meant for conservative investors. On the other hand, momentum is meant for aggressive investors. Between low vol and momentum, there is alpha low vol, which is the subject discussion which we are having right now, which is meant for almost all kinds of investors because in our understanding and our interactions, we've basically felt that almost 99% of Indians are in the moderate risk category, right? Because India has done so well in the last 10 years, we are no longer in the conservative category. New investors may be considered in the conservative category, but there are so many existing investors who now are considered basically as moderate risk taking investors. And still, there is some time before we reach the situation where most investors become very aggressive. So, moderate investors, for them, Alpha Low Vol is a very suitable product. Alpha Low Vol, as the name suggests, is a product which basically is a combination of low volatility and momentum or alpha. Now, if we look at basically how the particular portfolio is constructed, it combines two factors, low volatility and alpha. And basically, these two factors lead to a portfolio which is neither tilted towards momentum nor tilted towards low wall, but it is in between, and which is what the beauty of the product is. The universe, of course, of the product is 150 stocks. And so you get 100 large cap and 50 mid cap. Out of these 150 stocks, about 30 stocks or 30 stocks are selected. And then every 6 months, the rebalancing happens and we will delve into the methodology. But this is the core essentially this is India's first multi-factor smart beta ETF, and this was basically launched sometime in 2021. So there is a 4 year history. The index, of course, is managed by NSE, and that is a longer history of the index. But the ETF itself has now a 4 year history, and we do believe that for most Indian investors, this can be part of their core portfolio. Thank you.
All right, thank you for explaining all the basics. Now, considering the risk profile, are alpha low volatility ETFs more suitable for an aggressive investor or someone with a moderate risk appetite, as you have also mentioned, which is somewhere between low volatility and momentum? given that it is balanced between growth and volatility?
So I do strongly believe that the way the index is constructed, it can be a part of every investor's portfolio. Especially most of the Indian investors are in the moderate risk category, and there it can be a part of the portfolio because essentially the construction is very simple. 50% weightage is given to alpha, which is essentially those stocks which have done well over last 6 months and 12 months compared to the index. And 50% of the weightage is given to low volatility, which is stability. So the combined score of performance plus low volatility is what gives the 30 stock selection, which is a very steady selection. And we've seen in the past history, the steady selection of stocks or these stocks have a mix of some element of, a kicker to the returns portfolio, as well as it is stable. So for most investors, this is a very interesting product, uh, simple to understand if they keep it in terms of their mind, very simplicity, that this is something where you're basically choosing those stocks which have shown performance while also being stable or relatively steady in the universe of top 150 stocks in India. So you're basically sticking to the top 150 stocks which are very liquid, and you're picking 30 stocks which have the benefit of these two smart beta factors of alpha and low vol being combined together. The net result, because every 6 months the portfolio is changing, is that investors get a good long-term experience in terms of their risk-adjusted returns, which is what most investors should ideally look for. And hence, from an investor category perspective, it suits all investors. But definitely, we believe 99% of India's investors fall in moderate category, and for them, definitely this is a good product. For aggressive investors, they may choose momentum, that is possible. For very conservative investors, they may choose low vol, that is also possible, and both of these are available. But I do believe that for most Indian investors, alpha low vol is a beautiful combination of low volatility and alpha, which is essentially performance of the stocks in the last 6 months and 12 months compared to the index. And this will be a good add-on to the investor's portfolio for the long run. It is not meant for trading. If someone wants to trade, it is fine, but it's meant for long-term investment. And you will see the benefit of compounding as the years go by. Thank you.
All right. So as you have mentioned that it is for most of the investors in India comes into moderate risk category, and this ETF can suit their requirement. So in a way, are you saying that instead of choosing two separate funds of alpha and low volatility or momentum, the investor should choose a combination of it?
So yes, exactly. If, for example, if we choose low vol or momentum separately, that's as per investor risk appetite, they can do that. That's not a problem. If someone is very aggressive, you can go for momentum. If someone is not aggressive or is very conservative, you can go for low vol. But between low vol and momentum, there is alpha low vol, which gives you a mix of both. And for most Indian investors, this is a brilliant, suitable add-on to their existing portfolio. We are getting the benefit of alpha and low vol. So yes, for those who do not want to go either to the momentum or low vol, alpha low vol is a in between, which will suit well for long-term wealth creation. And we highly recommend it for every investor to pick it a part of their portfolio, long-term core investment portfolio, which they can keep adding on over long periods of time and get the benefit of the beautiful creation of this product, which is a combination of alpha and low vol.
All right. And in the current market conditions, which are very volatile, what can investors expect from this ETF?
So, exactly. So, when the markets are volatile, you need some element of stability, which is 50% of the portfolio weightage or 50% of the selection of this particular portfolio. When you do the ranking, there is a weightage given to stability or low volatility, which is the beauty of the product. So, on the one hand, 50% is alpha, which is essentially the performance of the performing stocks are selected out of the 150. The other 50% weightage is also given to stability. And the combination of these two, stocks which rank highest on a combined score of alpha and low vol are selected, which basically, even during these volatile times, makes this portfolio a good add-on to the investors for the long run. So it is an equity product with market volatility. It will be a little volatile, but the volatility will be lesser of this particular product because of the nature of construct of the product. And in the long
Mhm.
run, you will basically get the benefit of having the performers who have been relatively stable over the last 6 months and 12 months. And this combination, which keeps changing. Also, the risk measures like, a single stock generally is not more than 5% of the portfolio. The
Mhm.
smaller stocks don't become very large because there is inbuilt mechanism of restricting the weightage of the very small stocks relative to their weight in the index. All of that is being taken care of. So liquidity of the portfolio, the rebalancing of the portfolio, all of this adds on. So this is in some sense a passive fund with some element of thought process in terms of the right selection between alpha and low vol. And hence, even during this volatile times, you will find this particular portfolio having a decent track record. And we do believe that in the long run, this is a good add-on to the investor's portfolio because essentially, when you're investing in stocks, what are you looking at? You're looking at stocks which are performing, which is generating alpha. So this is selecting those stocks which have generated alpha in the last 6 months and 12 months. And generally in India, we've seen if there is a trend of stocks or sectors which are performing, you will find them performing for, so let's say, 2 years or 3 years or 4 years. So the ability of this portfolio to pick up trends or stocks which are outperforming and selecting them while keeping the stability aspect in mind is the beauty of this product, and that we believe is a nice long-term value addition to the investors because it is sector agnostic. It is not focusing on any particular sector. So whichever
Mhm.
sectors, combination of sectors are doing well, they will eventually find a way into this portfolio while having the top 150 stocks and the stability factors in mind, which builds this portfolio over the long run. So you basically are, in some sense, investing in stocks which are doing well. And generally in India, the trend is like I mentioned, 2, 3 years, 4 years, a particular trend lasts. So you capture that trend, and when the trend changes and some other sectors do well, because there is a 6 monthly balancing rebalancing involved, the
Mhm.
stocks which are underperforming will probably get out, and the stocks which are now performing will get in. So you get a combination of changing in sectors in a very smart manner through the smart beta ETF called Alpha Low Vol. Thank you.
All right. So it is a combination. So whenever the market conditions change, the ETF can also be reviewed, and it is a practice that every 6 to 12 months it is rebalanced according to the market condition. So in challenging market conditions, as you said, that under volatile periods, the low volatility factor works, and alpha always generates that return what every investor expects. But is it a good investment under market downturns also compared to the
So,
standard index funds?
so, specifically, when we talk about market downturns, in India, downturns are rare, but they do happen. We've seen that happening. Whenever there is a downturn in market, those have been good opportunities to invest for the long run. And we would firmly believe that investors look at this product with a 5 year view, not a 1 year, 2 year view. And whenever there's a downturn, if you add to the portfolio, you're eventually going to get the benefit of long-term investing. So, comparisons between, let's say, a large cap index and a mid cap index and a small cap index, since this is a combination of large and mid, you get top 50 names of mid cap. This is a product which is smart in character. So I wouldn't want to compare it with, let's say, market cap based indices, which can also have their ups and downs, right? So, for example, last 4 years, the Nifty large cap index, which is the market cap based index, has probably underperformed all other indexes. If the market falls very sharply, there is a very high chance that the large cap does much better than other indices. But if we look at the long run, then a combination of alpha and low vol has actually stood the test of time, has been able to deliver returns which are risk adjusted, and we do believe from an investor standpoint is a good addition to the investor's portfolio. And in downturns, you should add more. Asset allocation, of course, you should keep in mind at all points of time. And that asset allocation should be basically made by a professional advisor, an investment professional who can help you with your asset allocation. Once the asset allocation is made, whatever is your equity allocation, the Nifty low alpha low vol ETF should be a part of that portfolio. Thank you.
All right, so downturn should be used as more investment in whatever investment avenues one chooses. Um, so when it comes to stock selection, as you said that this is a sector agnostic, but is there mid cap and small cap stocks also included in the CTF?
So the passive funds work in a way where the methodology is known to investors, where the portfolio is also known to investors. And as part of the methodology, if you look at it, there is a universe which is already defined. So in this particular fund, which is ICICI Prudential Alpha Low Vol 30 ETF, the universe, the methodology of the underlying benchmark index, which is being followed by this fund, is already defined as 150 stocks. So top 500 large cap and 50 mid cap. So these 150 stocks will be the universe from which the selection will happen. So there are no small caps in this particular fund. There is only the universe of top 150 stocks, that is 100 large cap and 50 mid cap. Out of this 150 stocks, 30 stocks are selected, and these 30 stocks are selected every 6 months basis. The weightage, which is 50% given to alpha, 50% given to low volatility, and the total scores are then ranked, and the 30 stocks which have the highest scores on the basis of alpha and low vol are selected. So in some sense, it is a very simple product wherein top 150 names are there. There are no small caps. And generally, this fund, because of the fact that the way it is constructed, will have a large cap bias, which is also making it a steady portfolio. But it is sector agnostic. It can have, and it does have a 5% cap as far as a single stock exposure is concerned. So there is diversification of sectors, there's diversification of stocks. We believe 30 stock diversification is good, and it has large cap and some element of mid cap as well. So there is no small cap, but yes, it has 150 stocks, and we do believe that for most investors, this combination is a very good combination for the long run. Thank you.
Okay, so the inclination towards large cap stocks is what provides stability to these ETFs performance. Now comes my next question that every investment comes with risk. So while alpha low volatility ETF aim to balance um, uh, the growth and the stability, could you explain the potential risks as well of these two factor ETFs?
So the risks are very limited. The first risk which lies is, of course, the equity risk. So if equity markets go through a corrective phase, because this is focusing on the equity markets itself, there is an inherent risk of equity, which generally investors can avoid, or rather, through diversification of asset classes and an asset allocation plan, investors can reduce the risk of equity markets because equity risks we cannot remove, which is a systemic risk. Unsystematic risk, if we look at it, if, for example, there is a very sharp turn in the markets and there is significant, sector rotation which happens suddenly, there is short periods of time where this particular fund can underperform because if the past 6 months performers, 12 months performers suddenly go through underperformance, the 6 month period wherein the change is happening where these underperformers are there as part of the portfolio, there can be a mild underperformance, and hence I said that if you go towards a full cycle of 5 years, then these underperforming 3 4 months, because let's face it, in every style, every strategy, every smart beta factor index, or even every active fund management, there are times where the portfolio may underperform because investing by itself is a journey where the style does not work all the time. Most fund managers and most passive funds at different points of time can go through temporary times of underperformance. And then when the style works out, those underperformance is basically taken care of. So there will be times where this fund can marginally or underperform for a few months. It is that time where investors will have to show patience. And then, of course, when the style or these factors start performing, you will find that they will probably more than make up, and the investors' return experience will again improve. So, the two major risks are, of course, one is equity risk. So, equity market risk, which is a systemic risk, which we cannot avoid because it is investing in equities. Second is there will be times where this particular combination of factors which can underperform, much like any other style, this can also underperform. But if investors have a more than 5 year view, they will more than make up and generally have a good experience. So all I would say is have patience, invest for the long term. Don't worry too much about the risks, apart from the fact that equity markets are prone to risk. We all know that. But the risk is if we are investing for shorter terms, the risk is if we are investing our money with a view that in short term we'll make money and take it out. That does not work in equities. The longer term you keep, the better it is. So don't worry too much about the risk. Keep your asset allocation plan in place. Take advice from a professional advisor for investments, and you should be fine in the long run. Thank you.
Thank you for explaining it very simply. And now, my question is that normally people know about the traditional index ETFs and they go for it as a secure investment. But do you think that investing in alpha low vol ETF is a better option than that?
So, I mean, traditional investment options, yes, you rightly mentioned. So there'll be a large cap index, normal, typically top 50 or top 30 names. There'll be a mid cap index. There'll be a small cap index where people invest. Smart beta globally as well as in India is a rising trend wherein you're basically capturing some elements of, let's say, fundamental technical price factors, which basically in the long run have the potential to outperform, let's say, the large cap index or sometimes the small cap index in a downturn. Now, this is something where it is not necessarily a substitute for market cap based indices, but our past experience has shown that if, for example, you're looking at investing in large cap and mid cap, if you also invest in alpha low vol, you tend to get a add-on experience, which in the long run probably is slightly better. Now, it is not always true that it can be better because we none of us can predict the future. But generally, past trends have showed us that there is an element of smartness in the way the smart beta indices are selected. And hence, investors can basically experience themselves by starting a particular allocation. And then, as they get more comfortable, they can probably choose to have the right combination of market cap based indices and the smart beta indices as per their, long term goals. So I wouldn't say one is a substitute for the other, but as investors learn more and more, they probably get more comfortable with these smart beta indices, and then they can have an appropriate weightage combination between market cap based indices and the smart beta indices as the trend progresses. We are seeing more and more adoption of smart beta based indices by investors, and hence we are encouraged that in the long run they should get the benefit of these combination of factors or a single factor. Thank you.
Yes, now the awareness is increasing about smart beta, but still compared to traditional investment, it is much low. Though there are currently around 230 ETFs in the market, including gold ETFs as well. And portfolio numbers are also increasing, and it has reached to more than 2 crores. So I think that these are gaining their space in the market. Finally, my question is that please share some tips also for new investors considering alpha low volatility ETF as part of their investment strategy.
So I would only say again, one, equity markets is meant for the long run. Two, we are lucky that in India we have now have so many products which all the mutual fund or asset management companies are bringing on the active and passive side for us to create a portfolio. If you do not understand finance fully, please do have a professional advisor to help you, much like how we have doctors to take care of physical health. We need financial advisors for our financial health. And as part of the plan which they have, we do strongly believe at ICICI Prudential that there is a add-on benefit that you can get if you have the right selection of ETFs as well. Within that, we strongly believe that most Indians can have something like your ICICI Prudential Alpha Low Vol 30 ETF as part of your long-term core portfolio, which can do well for investors in terms of providing them with 30 stocks selected out of 150 names, and these 30 stocks on the basis of alpha and low vol. We've basically seen in the past, it's a good add-on to the existing investors' portfolio. So the simple tip is invest for the long run, invest with patience, invest through professional advice, and invest in smart beta factors like alpha and low vol, which is the ICICI Prudential Alpha Low Vol 30 ETF, which basically will give you a good combination of two factors, and it is, I think, to date, a very popular index, and it is getting more and more popular. Thank you so much.
Thank you, Mr. Haya, for sharing your valuable insights with us, and I'm sure our listeners found this session insightful. It's important to note that the contents of the discussion should not be construed as an editorial recommendation from Outlook Money. And with that, we come to the end of today's episode of the Investment Made Easy podcast. Stay tuned for the next edition in the Outlook Money's podcast series, and don't forget to like, share, and subscribe. If you have any suggestions, feedback, or questions, please send them to us at letters@outlookmoney.com. Until our next edition, take care and stay well, and keep following Outlook Money, your go to personal finance magazine.